I don't know whether you caught it, but in the news about a week ago, there was an article about the millions of Americans that are now eligible to be Canadians, and they're moving to Canada. Well, what does that mean? Well, Sonya Dolguina is a cross-border tax consultant. She's also co-author of Your Move to Canada. She's going to join us right after this word from our sponsor. Sonia, a real pleasure to meet you.
Yeah, thank you so much for having me on the podcast, Pat.
Okay, I introed with this news article about millions of Americans eligible for Canadian citizenship and moving to Canada. Do you think that's going to happen?
I think so. I don't think millions of them are going to move, but I think quite a few will. So, what this news article was about was this recent Bill C3 that became law in December 2025. And what this law does is it removes generational limits on getting Canadian citizenship by descent. So, what it effectively means is Americans, if they have a parent, grandparent, great grandparent who was a Canadian citizen, they are also now Canadian citizens by law. They just have to prove it and go through that process. So there's a significant amount of Americans who have some Canadian lineage. If they go through the process, they can get Canadian citizenship too. Now, will they actually move to Canada? I don't think all of them will. I don't think all of them will go through the paperwork to actually get this Canadian passport, but a significant amount definitely are.
Okay, well, you're a tax expert for cross-border stuff. How many Canadians actually go to Canada? I mean, I'm not talking snowbirds. I'm talking people that go and move there permanently.
So, how many Canadians go to move to the US permanently?
Yeah.
Yeah, so recent data from Stats Canada did show that percentage, interestingly, has actually been declining over the past couple decades to go permanently. So that's looking at Canadian residents who went and got a permanent residency in the U.S. or a green card. So that amount has been going down. It looks like in the last data from a couple of years ago, it's about 20,000 people. But that said, those statistics actually don't capture a huge category of mobility, which are Canadians who are going down to live in the US on a temporary visa, such as a H-1B or a TN. So those are folks who don't necessarily ever get a green card, but they could still live and work in the US and, start investing in the US and have US tax exposure and financial issues with the US. So they could be there for a number of years, but they ultimately will likely return to Canada. So they're not captured in that statistic.
A lot of people that I know in this area, go down for holidays to Florida. A lot of them, Quebec, Ontario, head down to Florida.
Yeah.
If you're out west, you head down to Phoenix, Arizona, you go to California, and in many cases, they own real estate there.
Hmm.
What are the key hurdles going back and forth and owning real estate in both countries?
Yeah, good question. So I'll start with the Canadian snowbirds in your example, and then I'll chat about Americans who are maybe buying Canadian property. So the
Mm.
big one is if someone owns personal use property in the U.S., they don't necessarily trigger U.S. tax filing obligations as long as they stay within a certain number of days in the U.S. But once they sell that real estate, if a Canadian who doesn't have any U.S. status, if they sell U.S. real estate, they may have to pay capital gains taxes. And a lot of our clients that we've seen, given the devaluation in Canadian dollar, they sell their US property and they actually have a pretty significant capital gain in Canada just because since they bought their property, maybe the dollar was on par beforehand. And then once they sold it, the Canadian dollar has gone down a lot. So it could result in a pretty big capital gains tax in Canada. And then also in the US. So a big hurdle is that once you sell a US property, if you're not a US person, there's something called FIRPTA withholding in the US. So if you're not a US person, you sell US property, there could be a withholding tax on the about up to 15% of the proceeds on the sale of the home. And in order to recover part of that, you do have to file a US tax return. And so that requires getting a US tax ID, filing a US non resident return. If the property is in a state that has a state income tax, you have to file a separate return. And I've definitely seen some examples is if these, US filings aren't done perfectly and to a T, some people have had to wait years to get some of that tax withholding back. So I definitely suggest that folks who are interested in selling US property and they're not American citizens or green card holders or residents work with a good cross border accountant who can help you with that. So, next we could chat about kind of Americans want to buy property in Canada or Americans who are moving to Canada. What are some of the real estate considerations? So, a really common one I'm talking to people about these days is well, they moved to Canada, but they haven't sold their US home yet, and they're worried about selling the US property after they move to Canada, and do they have to pay a big capital gains tax and to the CRA? So the answer is not necessarily. When someone moves to Canada and becomes a Canadian tax resident, you get something called a step up in your cost basis for capital gains purposes, which means your capital gain in Canada on the the sale of assets, including investments and property, is the value is the difference between what you sell it for and what it was worth when you came to Canada. So if someone sells their property pretty shortly after arriving in Canada, there might not be a capital gain, and even if there is, you could also use selling expenses such as realtor commissions and legal fees to offset that. Another thing is, how is the U.S. going to tax the sale of that property? In Canada, we have an unlimited principal residence exemption, but the U.S. actually caps it at $250,000 per person or $500,000 for couples filing jointly. But in order to use that exemption, you had to have used that property as your home for at least 2 out of the last 5 years. So when I talk to Americans who say, oh, I don't think I'm going to sell my home yet, I'm going to move to Canada and just hold on to it, I say, yeah, that shouldn't be a problem. But you have a bit of a deadline to actually sell that home within, roughly 3-4 years after using it as a home. Otherwise, you lose the ability to shelter up to $500,000 of capital gains in the U.S.
You are blowing my mind, but I guess I shouldn't be. I was born in the United States. My parents were working down there at the time, and raised in Canada. So I have a dual citizenship. So I know
Yeah,
I have to pay taxes in both countries. And my experience has been that I pay higher taxes in Canada and lower in the United States, on a federal level at least. Is that
yeah.
your experience as well?
Yeah, so it's always interesting having this conversation about US tax rates versus Canadian tax rates. On the surface level, yes, oftentimes Canadian tax rates are higher than US tax rates, especially when you're comparing someone who's only subject to US federal tax. So, someone like you who lives in Canada, or someone maybe who lives in Nevada or Florida. And because the US allows for joint filings with married couples, that can result in the effective rate being lower for married couples, especially when there's a discrepancy between earnings. But whenever we have this conversation, I kind of want to take folks to take a step back and say, okay, what do our Canadian taxes actually pay for? Because you ultimately have to pay for these things potentially out of pocket in the US. For example, healthcare costs. In the US, you have potential healthcare premiums that you pay out of pocket, and additional out of pocket costs and copays and deductibles, unless you have, a stellar plan through your employer. And these are things that potentially are covered by our tax dollars in Canada. Another example is post secondary education. It's heavily subsidized in Canada through our taxes. I've spoken to Americans who've moved to Canada and they've paid for their children's university in Canada, and they say, if I had to pay for US tuition, it would have been 5 or 10 times more expensive for a 4-year degree. And also, property taxes oftentimes a bit lower in Canada compared to the US. So, on the surface, yes, Canadian income taxes can be higher, but we want to look at what are these taxes paying for, and like holistically, are our out of pocket costs higher in Canada than they would have been if I lived in the US? Not necessarily. It really depends. It's on a case by case basis.
Yeah, true. And state by state too.
Yes.
Usually when you pay your taxes in Canada, my experience again has been that, you pay your provincial and your federal at the same time. They're there in
Yeah.
separate filings, but if down the states you file federally, then you file by state.
Yeah.
And I lived in New Jersey and it was outrageous. California is even
Yeah.
worse.
Yeah. And also, some states have city tax filings.
Yep.
Like I think New York City. I know in Oregon they have like county or state level or sorry, county or city level filings. So yeah, the taxes don't necessarily end at the state.
That's what taxes are all about. Speaking
Yeah.
of taxes, and not avoiding taxes, but taking advantage of what's available to you. Here in Canada, we have our RSPs. We have tax-free savings accounts. In the States, they have 401ks and IRAs. What are the differences people need to be aware of?
Yeah, great question. So the 401k and the RSP, they're both pre-tax retirement accounts. You make a contribution, you get a tax deduction, any growth within the account grows tax-free, and then you pay taxes when you take the funds out. So under the Canada-US tax treaty, generally both countries recognize the tax-deferred status of the accounts, which means if you have an American who has a a traditional IRA or a 401k and they move to Canada, Canada will recognize the tax deferred treatment. If you have a Canadian who moves to the US with an RRSP, US will recognize the tax deferred treatment of the IRS federally, but not all states recognize tax treaties. For example, California does not recognize the tax free status of an RRSP, so you actually have to pay taxes on your earnings within the RRSP in those sorts of states. So those are a really big difference that I always talk to clients about who are moving from the US and have an IRA is the difference for estate planning purposes. So as you may know, when you have an RSP, upon the death of the last surviving spouse, or an RSP or RIF, you're deemed to have distributed it upon death, which can result in a huge tax bill, up to half of that account going to the CRA. Whereas the US, with the IRA, even if someone is in Canada and they pass away with an IRA or 401k, there's actually no deemed distribution at death. There's something called an inherited IRA rule. So it continues being a tax deferred account for your beneficiary. And they just have to make minimum distributions and they pay taxes at their level. So it's actually, and generally, if you leave it to like a child, for example, they have to wind it down over 10 years. So it actually ends up being quite tax efficient to have an IRA or a 401k rather than an RRSP.
Wow. There are a lot of moving parts. Um,
Yes.
what are the key strategies or what are the key tax planning things you have to think about when you're moving between the two countries? I mean, boil it down so I don't have to go through all those parts.
Yeah. Well, I wrote a whole book about it, so there's so many
By the book.
strategies. But yeah, buy the book if you want to learn about more. But I'll go through a couple of big ones that we see often. We could first talk about leaving Canada and going to the US. So when someone ceases Canadian tax residency, there's something called like a departure tax, and it's a deemed disposition of assets at fair market value. So you're treated for tax purposes as if you sold those assets, um, even though you didn't sell anything. So generally, the Canadian registered accounts and Canadian real estate doesn't apply, but things like investments in your non-registered accounts can trigger this deemed disposition. So in terms of planning, you kind of want to make sure that you know about this ahead of time. See if there's any strategies. For example, you can make an RRSP contribution if you have room to offset that capital gain. And on the US side, you need to file an election with your US tax return to get a step up in cost basis on the US end for assets that were subject to deemed disposition. Otherwise, you don't want to maintain your original cost basis in the US and pay tax again on that gain when you eventually sell that asset, since Canada already taxed that gain with the departure tax regime. So there's an election you could file. So that's a really important one. A big one when moving between countries is once you're going to be a US taxpayer, whether that's a Canadian moving to the US or a US citizen moving to Canada, you want to avoid certain investments such as non-US mutual funds or non-US ETFs. These can be known as PFICs for US purposes, and there are potentially pretty big issues with them. They require separate IRS filings for each individual PFIC held. And on top of that, there's some punitive rules around them for US purposes. So when we have a Canadian moving to the US, again, look at your portfolio. What kind of investments do you have? If it's all Canadian ETFs and mutual funds, and generally this doesn't apply if they're within RRSPs or RIFs, but if they're like in a TFSA or RESP or a non-registered, you're going to want to potentially look at not holding those anymore and holding, say, individual securities or US-based ETFs instead.
Wow. Maybe
Yeah.
just sell everything and walk across the border with cash.
Well, that's the thing is people say, oh, what if I sell anything, I'm triggering capital gains. Well, if they're in a registered account, like an R or a TFSA or an RESP, there's no capital gains to pay if you trigger those gains. If they're in a non-registered account, well, they're subject to departure taxes anyways. So it may make sense to just sell them. I'll give a quick example of some strategies for Americans moving to Canada. That
Yeah.
one big one that we talk about is the Roth IRA. So it's interesting if a Canadian moves to the US and has a TFSA or an American moves in Canada, the IRS doesn't acknowledge the tax-free status of the TFSA. So that's something that people need to keep in mind. It's a taxable account in the eyes of the IRS. But if you have a Roth IRA, which is kind of like the equivalent of a TFSA, A Roth IRA can be a tax-free account in Canada as long as you file an election with the Canadian government and you don't make any Roth contributions or conversions during your Canadian residency period. So always, whenever I talk to Americans who haven't quite moved yet, I talk to them about their Roth, see if there's any strategies to maximize that Roth account ahead of coming to Canada, because then it becomes like another tax-free investing account in Canada.
I don't want you to diss any of your coworkers, but financial planners in Canada know what they're doing in Canada. And I
Mm-hmm.
guess a financial planner in the United States knows what he's doing in Canada. But how many financial planners, you just have to ballpark it, actually know how to handle cross-border? I mean, sure, buy your book, I get it. But how many could actually do it if you walked in the door?
Yeah, that's a really good question. And I don't have a specific number for you, but I will say that unless the planner or that financial advisor you're working with has extensive experience working at a cross border wealth management firm or a cross border financial planning firm, they likely don't have a lot of them don't have the expertise to deal with this to deal with these matters. For like, I'll give you an example. U.S. citizen walks into a bank, and the bank says, "Let's open you a TFSA and buy you a bunch of Canadian mutual funds." I see it all the time. You just triggered a bunch of tax issues for that U.S. citizen. So unfortunately, a lot of people, don't have the expertise. There are a few cross-border wealth management firms located in Canada that are licensed in both Canada and the U.S. I personally work as a tax consultant at one of them. So generally, very good idea to work with people who are qualified in Canada and the U.S. Even if you don't have any assets in the U.S., hopefully the person you're working with, if you're a U.S. citizen moving to Canada, knows about tax issues for Americans, because the IRS will follow US citizens no matter where they live in the world.
Entirely true. Sonia,
Yeah.
we've got you, and we've got your book too, Your Move to Canada, but you cover both ways, right?
Yeah, so the book focuses on people moving from the US to Canada. Um, Hopefully, one day I'll release a book about Canadians moving to the US, but it might take a couple of years. The last chapter does talk about ceasing Canadian tax residency and moving back to the US, but the book is focused on moving from the US to Canada, whether you're a Canadian moving back after living in the US for a number of years, or a US citizen who's working and moving here for the first time.
Sonia, great to chat. Thank you so much for your time.
Yeah, thank you so much for having me.
Sonia Dolguina is a tax consultant and co-author of Your Move to Canada.